Silver looks calm. The chart barely moves. No panic, no spike, no signal. And that is exactly the problem, because markets do not always break loudly. Sometimes they hollow out quietly, while the screen keeps pretending nothing is wrong. Today, silver is trading normally, but behaving abnormally. Open interest is thinning. Physical premiums refuse to fall. Delivery pressure is rising without showing up in the price. This is not volatility. This is absence. A market that functions because everyone agrees not to ask a dangerous question. What happens if too many people ask for the metal? Silver is no longer just an investment asset. It is a strategic input. Solar infrastructure, defense systems, electronics, energy transition. Governments do not speculate on silver. They secure it. And this creates a fault line. On one side, paper markets built for liquidity, leverage, and speed. On the other, sovereign buyers and industrial users who need delivery, not exposure. These two worlds can coexist only as long as physical supply is abundant. But when supply tightens, the paper market becomes fragile. Because you cannot print metal. January 17th was not dramatic. No headlines, no crash. But something changed. Paper silver traded sideways, while physical indicators quietly decoupled. Premiums stopped responding to price drops. Delivery demand concentrated into fewer contracts. Open interest declined, not because risk disappeared, but because confidence did. This is what divergence looks like. Not panic, but withdrawal. Smart participants do not fight broken structures. They step away. The futures market is a performance. Thousands of contracts, millions of ounces, endless liquidity. But most of it is never meant to settle. Positions are rolled, exposure is traded, cash replaces metal. This works until it doesn't, because leverage depends on belief. Belief that delivery is optional, belief that settlement will remain orderly, belief that someone else will never ask for bars. A futures market can sell far more silver than exists, as long as nobody demands proof. Now look at the structure. Registered inventories, eligible inventories, open interest. The ratio matters more than the price. When fewer participants are willing to stand for delivery, when contracts shrink instead of expand, when leverage quietly compresses, that is not strength. That is risk management in motion. This is how pressure releases, not through explosions, but through exits. Official explanations are calm. Supply is sufficient. Markets are orderly. Volatility is normal. And individually, these statements are not lies. They are incomplete. Institutions speak in averages. Markets break at the margins. No one rings a bell when confidence erodes. No one announces when trust is withdrawn. They simply stop participating. Liquidity is not volume. Liquidity is the ability to exit without distortion. When real liquidity disappears, prices do not collapse immediately. They freeze. Bid-ask spreads widen. Delivery becomes inconvenient. Cash settlement becomes encouraged. This is not failure, it is containment. And containment always precedes repricing. Every analyst has a threshold, not a price, a condition. Mine is simply, when a system sells more metal than it can confidently deliver, risk no longer belongs to the buyer. It belongs to the structure. At that point, participation becomes a choice, not an assumption. Big money does not panic. It reallocates. Quietly, patiently, without announcements. Silver is not screaming, it is whispering. And the most dangerous signals in markets are the ones that sound like silence. If you want to understand silver, gold, and the global debt system as they evolve, not after headlines break, stay here. This story is not over. The price is no longer the signal. There was a time when price told the story. If supply tightened, price rose. If demand weakened, price fell. That relationship is now broken. In today's silver market, price is no longer a discovery mechanism. It is a managed output. Real stress does not appear on the chart. It shows up in delays, in premiums, in contract behavior, and in who quietly stops showing up. This is why watching price alone has become misleading. The signal has moved elsewhere. Why fewer contracts matter more than higher volume. Most people assume danger comes from rising volume. In reality, it comes from shrinking participation. When open interest declines during periods of rising strategic demand, it means risk is being avoided, not resolved. Participants who understand delivery dynamics do not fight leverage. They step aside. A thinning market is not a healthy market. It is a market losing its shock absorbers. And when stress finally arrives, there are fewer participants left to absorb it. The unspoken role of cash settlement. Cash settlement is often presented as efficiency. In practice, it is a pressure valve. When physical delivery becomes uncomfortable, systems incentivize cash instead of metal. This keeps prices calm temporarily, but it introduces a dangerous precedent. Once delivery becomes optional in practice, the entire contract changes character. At that point, the market is no longer trading silver. It is trading confidence. Why March matters without making predictions. Delivery months are not dangerous because of what happens. They are dangerous because of what might need to happen. March concentrates decision making. Stand for delivery or don't, roll or exit. Accept metal or accept cash. Most stress is resolved quietly, but each cycle leaves a residue. Less trust, more caution, lower tolerance for leverage. That accumulation is invisible until it isn't. The slow migration away from leverage. This is the part no chart shows. Risk does not leave markets all at once. It migrates from futures to forwards, from exchanges to private contracts, from visible venues to opaque ones. This is not collapse behavior. It is preparatory behavior. And historically, it appears before repricing events, not after. The question no one can answer publicly. Here is the question professionals ask privately. How much silver must be demanded physically before the paper market is forced to admit constraint? No one knows. But everyone who understands structure respects the possibility, and markets do not need certainty to reprice. They only need doubt. Where this leaves ooze, silver is not broken. But the mechanism used to represent it may be. And when representation fails, reality eventually reasserts itself. Not violently, not dramatically, but decisively. If you're watching price, you're late. If you're watching structure, you're early. And the difference between the two is where outcomes are decided. The most dangerous phase in any market is not collapse. It is normality under pressure. That is the phase silver is in now. Prices move just enough to appear functional. Liquidity appears just deep enough to feel reliable. Institutions speak just confidently enough to maintain order. But beneath that surface, the system is doing something unusual. It is reducing exposure without changing price. And that should immediately raise a red flag. Because when risk leaves a system, but prices don't adjust, it means information is no longer being transmitted honestly. Markets exist to signal scarcity. When they fail to do that, scarcity does not disappear. It accumulates. Why this is not a supply story, it's a control story. Most commentary frames silver stress as a supply issue. That is incomplete. Supply problems create price spikes. Control problems create distortions. Silver does not lack metal in absolute terms. It lacks deliverable flexibility at scale. That difference matters, because a system can survive limited supply. It cannot survive loss of optionality. Optionality is the ability to say yes when asked, and increasingly, the silver market is structured to say, yes, but not like that. Yes, but later. Yes, but in cash. That is not abundance. That is constraint management. Why paper markets are designed to avoid truth. Paper markets are not evil. They are efficient. They are built to compress risk, smooth volatility, and allow massive participation. But they rely on one assumption: that physical settlement remains rare. The moment physical settlement becomes common, the design breaks, because leverage works only when delivery is the exception. In silver, delivery is quietly becoming less comfortable. Not impossible, not failing, just inconvenient. And inconvenience is the first stage of refusal. The hidden mathematics of stress. Most viewers never see the real math. They see price. But the real equation looks like this. Deliverable supply versus obligations that could request delivery adjusted for. Who is psychologically willing to stand? That last variable is the most important. Because markets are not physical systems. They are behavioral systems, and behavior changes before inventory does. When participants no longer believe delivery will be smooth, they stop pressing the system. That reduces open interest. That reduces visible stress. And paradoxically, that makes the system look healthier right before it isn't. Why declining open interest is a warning, not relief. Many analysts celebrate falling open interest. They say leverage is clearing. They say risk is leaving. But they miss the question. Why is it leaving? Leverage doesn't evaporate randomly. It exits when reward no longer compensates risk. In silver, the risk is not price volatility. It is settlement uncertainty. The fear is not loss. It is friction. And sophisticated money avoids friction more aggressively than loss. The psychological shift nobody tracks. There is a subtle psychological shift happening. Participants are no longer asking, where will price go? They are asking, if I need metal, will I get it cleanly? That question changes everything. Because once that question enters the system, paper instruments lose their dominance. Not suddenly. Gradually, and gradual shifts are harder to detect until they become irreversible. Why institutions will never warn you. Institutions cannot say the quiet part out loud. They cannot announce. Delivery could become uncomfortable. Liquidity may not behave as expected. The structure assumes cooperation. Because markets run on confidence. And confidence cannot survive transparency about fragility. So instead, institutions do what systems always do under stress. They reframe. They say conditions are normal. They call divergence temporary. They describe stress as localized. None of these statements are false. They are incomplete by design. What happens when everyone knows, but no one acts? This is the most unstable equilibrium in finance. When everyone sees the issue, but assumes someone else will move first, because the first mover pays the cost. The second mover gets confirmation. The last mover gets trapped. This creates paralysis, and paralysis keeps prices calm until one participant breaks formation. And when that happens, the system does not adapt smoothly. It gaps. Why silver is different from other metals. Gold absorbs stress. It has deep sovereign trust. It has monetary history. It has centralized custody. Silver does not. Silver is industrial, strategic, and monetary. Without the protections of any single category, it is consumed. It is dispersed. It is politically invisible. That makes it vulnerable to underinvestment. And underinvestment creates fragility long before shortages appear. The illusion of inventory. Warehouses report numbers, but numbers do not equal availability. Inventory is not static. It is spoken for, pledged, hedged, and promised. The same ounce can support multiple claims, as long as those claims are not exercised simultaneously. This works beautifully in calm conditions. It fails quietly under stress. And stress does not need to be extreme. It only needs to be misaligned. Why the next phase won't look like a crisis. There will be no headline saying, silver market fails. That is not how modern systems break. Instead, you will see a more cash incentives, a more contract flexibility, the more off exchange arrangements, a more alternative solutions. Each of these is presented as innovation. Together, they represent avoidance. And avoidance always precedes repricing. The silent repricing mechanism. Repricing does not begin with price. It begins with terms. Who can buy? How much? Under what conditions? With what guarantees? By the time price reacts, structure has already shifted. That is why late participants feel shocked. They are reacting to price. Early participants are reacting to access. what this means for viewers who are actually paying attention. If you are watching this, you are not here for predictions. You are here for process. And the process is cleared. Silver is entering a phase where representation diverges from reality. That divergence cannot persist indefinitely. Not because of collapse, but because incentives do not support it. And markets always follow incentives. The most important question going forward. Forget price targets. Forget timelines. Ask this instead. What happens to a market when belief in smooth settlement fades, but no alternative system is ready to replace it? That gap, that uncertainty, is where repricing is born. Not loudly, not dramatically, but structurally. Final thought, and why this matters now. Most people study markets when they move. Professionals study markets when they stop behaving normally. Silver is not screaming. It is pausing, and pauses under pressure are never neutral. They are decisions being made quietly. If you understand that, you are not early. You are aware, and awareness is the only advantage markets still reward. Silver is behaving in a way that confuses most observers. The price remains steady enough to signal stability, yet the behavior underneath suggests restraint. This is not the kind of tension that shows up in headlines. It is the kind that reveals itself only when participants begin changing how they interact with the system rather than what they say about it. When markets stop communicating stress through price, they begin expressing it through structure. What makes this moment unusual is not scarcity, but hesitation. The silver market is still functioning, still trading, still clearing. Yet fewer participants are willing to lean into leverage. Fewer are comfortable holding exposure for extended periods. That shift matters because markets are sustained not by volume alone, but by confidence in process. When that confidence softens, behavior changes first, and price reacts last. Most people assume risk announces itself through volatility. In reality, the most serious risks emerge during periods of calm. Stability allows imbalances to grow unnoticed. It encourages participants to believe that the absence of disruption is proof of strength, when in fact it may be evidence of suppression. Silver's current calm is not reassurance. It is a signal that stress is being absorbed elsewhere. The structure of the paper market depends on one critical assumption, that physical settlement remains rare. Futures contracts are designed for exposure, not extraction. When that assumption holds, leverage is efficient and liquidity appears endless. But when delivery becomes even slightly inconvenient, the system begins to redirect demand away from metal and toward cash. That redirection is subtle, but it changes the nature of the market entirely. At this stage, the most important movements are not visible on a chart. They appear in contract behavior, in who chooses to roll positions, and in who quietly steps aside. These decisions are not emotional. They are rational responses to uncertainty. Participants who understand structure do not wait for confirmation. They move when friction appears, not when failure becomes obvious. Institutions, meanwhile, continue to project confidence. Official language remains calm, measured, and reassuring. This is not deception. It is necessity. Markets rely on continuity, and continuity relies on belief. A system cannot publicly acknowledge its own fragility without accelerating the very outcome it seeks to avoid. So stress is managed, not announced. What follows in such environments is not an immediate break, but a gradual shift in terms. Delivery becomes less attractive. Cash becomes more convenient. Liquidity becomes conditional. None of this feels like crisis. In fact, it feels orderly. That is what makes it effective. Modern market adjustments are designed to preserve surface stability while absorbing structural strain beneath it. Over time, however, these adjustments accumulate. Each cycle resolves tension without eliminating it. Each resolution leaves behind a small residue of doubt. And markets do not need widespread panic to reprice. They only need enough participants to quietly agree that the rules are changing. Silver does not need to collapse to revalue. It only needs the mechanism that represents it to lose credibility. When representation diverges from reality, price eventually follows structure. Not abruptly, not dramatically, but decisively. This is why the most important question is no longer where silver's price is headed, but how long the current structure can continue to function without revealing its limits. That answer will not come from charts or commentary. It will emerge from behavior. And behavior is already shifting. The silver market has entered a phase where outcomes are no longer determined by action, but by restraint. Nothing is failing. Nothing is breaking. Yet decisions are being delayed in ways that rarely appear when systems are healthy. When participants hesitate to commit despite stable conditions, it signals that certainty has been replaced by calculation. There is a growing gap between what the market allows and what it encourages. Contracts still exist, liquidity still flows, but the incentives have shifted. The system quietly rewards those who accept cash over metal, speed over certainty, flexibility over finality. These are not random preferences. They are responses to pressure that has not yet found a visible outlet. The most revealing behavior is not demand, but avoidance. Certain participants are no longer asking whether silver is undervalued. They are asking whether exposure can be exited cleanly under stress. That question alone changes the risk profile of every position. Once it enters the collective mindset, the market begins preparing for scenarios it will never publicly discuss. What makes this stage particularly unstable is that everyone involved understands the structure, but no one wants to test it. The first participant to demand clarity exposes themselves. The last participant risks being trapped. So the system remains suspended in cooperation, functioning not because it is strong, but because no one wants to be responsible for revealing its limits. This creates a strange illusion of control. Prices behave. Volatility remains contained. Official explanations remain credible. Yet beneath that calm, optionality is narrowing. Choices that once felt routine now carry consequence. Settlement that once felt guaranteed now comes with conditions. None of this triggers alarms. It simply changes behavior. At this point, stress no longer needs to increase to cause disruption. It only needs to persist. Time becomes the pressure. Each cycle that passes without resolution compresses tolerance further. The system does not weaken all at once. It tightens. And tightening systems do not announce when they reach their limit. History shows that markets in this position do not fail forward. They pause, redirect, and reprice indirectly. The transition is rarely visible in advance because it happens through adjustments that appear reasonable in isolation. Only in hindsight do they reveal a pattern. The critical moment will not be marked by panic. It will be marked by a choice that suddenly feels unavailable, an option that quietly disappears, a flexibility that no longer exists. By the time that moment becomes obvious, the market will already be somewhere else. Until then, silver will continue to look calm. And that calm will continue to be misunderstood. Because the most important changes are no longer happening in price. They are happening in permission. The silver market is now operating in a zone where visibility no longer equals transparency. Everything can be seen, yet very little can be understood at a glance. Data is abundant, but clarity is scarce. This is the environment in which complex systems begin to mislead even experienced observers, not through deception, but through familiarity. When nothing appears broken, assumptions go unchallenged. One of the most overlooked dynamics in markets under strain is the redistribution of responsibility. Risk does not vanish, it migrates. In silver, that migration is occurring away from centralized venues and toward bilateral arrangements that do not rely on public settlement mechanisms. This shift does not reduce stress. It merely relocates it beyond the reach of visible metrics. As this transition accelerates, the role of the exchange subtly changes. Instead of serving as the primary arena for price discovery, it becomes a reference point, a baseline rather than a battlefield. Real negotiation happens elsewhere. The posted price remains useful, but it no longer captures urgency, scarcity, or leverage constraints. It becomes a number that explains less with each passing cycle. What makes this especially difficult to detect is that the system continues to perform its function. Trades clear. Contracts settle. Inventory reports update. From the outside, nothing seems amiss. But internally, the conditions under which these outcomes are achieved are becoming increasingly conditional. Each resolution requires more coordination, more flexibility, and more unspoken agreement than the last. In such environments, time replaces volatility as the dominant force. The longer the structure holds without release, the more sensitive it becomes to minor disruptions. A single logistical delay, a regulatory adjustment, or a shift in industrial demand can carry disproportionate impact. Not because the system is weak, but because it has already absorbed so much pressure that it has little elasticity left. Another quiet development is the changing profile of participation. The most stable contributors to liquidity are no longer the most visible. Instead, they operate with reduced exposure, shorter duration, and greater optionality. This behavior is often mistaken for disinterest. In reality, it reflects a refined assessment of risk, one that prioritizes exit over engagement. Meanwhile, new entrants continue to rely on outdated signals. They read price as truth, volume as validation, and stability as safety. What they do not see is the gradual erosion of the conditions that once made those signals reliable. By the time the discrepancy becomes obvious, the informational advantage has already shifted. The most telling indicator is not what participants are doing, but what they are no longer willing to do. Certain trades that once seemed routine now require justification. Certain exposures that once felt neutral now carry hesitation. These changes do not originate from fear, but from experience. They represent lessons learned quietly, not warnings issued publicly. At this stage, the market's greatest vulnerability is not a shortage of metal, but a shortage of tolerance. The system depends on continued cooperation across participants with increasingly misaligned incentives. As long as that cooperation holds, stability persists. But cooperation is not guaranteed. It is a choice renewed with each cycle. Eventually, a moment arrives when cooperation is no longer the rational option for someone. Not because of panic, but because the balance of cost and benefit has shifted. When that moment occurs, the system does not collapse. It reconfigures. And reconfigurations are rarely symmetrical. The first sign of that reconfiguration will not be a dramatic move in price. It will be a change in availability, a tightening of terms, a preference expressed indirectly. These are the early signals that representation is adjusting to reality, even if the headline numbers lag behind. For observers focused solely on price, this transition will appear sudden and confusing. For those watching structure, it will feel overdue. The divergence between these perspectives is where misunderstanding thrives and where opportunity quietly forms. Silver does not need an external shock to change. It only needs the internal alignment that has sustained it to weaken slightly. That weakness does not announce itself. It reveals itself only when options disappear and assumptions fail. Until then, the market will continue to function. And that functionality will continue to be mistaken for stability. At first glance, nothing seems urgent. Silver trades, clears, and settles like it always has. The numbers update. The charts move just enough to suggest balance. This is precisely why the moment matters. Because systems rarely fail when everyone is watching. They drift when attention relaxes. What is changing now is not supply, not demand, and not price. It is behavior. Participants are no longer engaging the market the way they used to. Decisions that were once automatic now require justification. Exposure that once felt neutral now carries questions. These are not emotional reactions. They are calculated adjustments made by those who understand where friction begins. There is a quiet reassessment underway regarding what ownership actually means. Holding exposure through a contract is no longer assumed to be equivalent to holding metal. That distinction, once theoretical, is becoming practical. And when a market forces its participants to rethink basic definitions, it signals a deeper shift than price alone can reveal. The structure still works, but it works differently. Each settlement requires more negotiation. Each rollover carries more intention. Flexibility is rewarded, certainty is deferred. None of this triggers alarm bells because it is framed as efficiency. But efficiency that depends on constant accommodation is not strength. It is adaptation. The most revealing change is how risk is being discussed, or rather, how it is not. Conversations have moved away from upside and toward continuity, away from returns and toward access. When market participants prioritize the ability to exit cleanly over the desire to gain exposure, the underlying incentive system has changed. This creates an unusual standoff. Everyone sees the same data, yet no one wants to be the first to test its limits. Acting too early invites scrutiny. Acting too late invites constraint. So the system continues forward, powered by mutual hesitation rather than confidence. History shows that markets held together by hesitation do not unravel suddenly. They recalibrate. They redefine terms quietly, then retroactively call the outcome inevitable. The moment itself is rarely dramatic. It is the realization afterward that feels abrupt. The next phase will not announce itself with headlines or spikes. It will arrive as an absence. Something that used to be available will no longer be offered on the same terms. A choice that once felt open will quietly close. Those watching price will ask when it happened. Those watching structure will already know. Silver does not need chaos to change direction. It only needs enough participants to decide that the current arrangement no longer serves them. When that threshold is crossed, adjustment becomes unavoidable, even if it remains orderly. Until then, the market will remain calm, and that calm will continue to invite misunderstanding. Because the real story is no longer in what silver is doing. It is in what it is quietly refusing to do. The most misunderstood phase of any market cycle is the one where nothing appears to change. That is when observers relax, analysts recycle explanations, and participants convince themselves that stability has returned. In reality, this is often the phase where the system is deciding what it can no longer support. In silver, that decision is unfolding slowly, not through announcements or disruptions, but through constraints that are being introduced incrementally. Limits that feel temporary, adjustments that seem procedural, each one small enough to ignore, but together forming a new operating reality that did not exist before. What makes this phase difficult to navigate is that cause and effect become separated by time. Actions taken today do not show consequences immediately. Instead, they accumulate. Pressure builds invisibly, absorbed by flexibility, cooperation, and delay. But flexibility is not infinite. It only masks imbalance until it reaches its limit. The market's resilience is now being tested not by demand, but by duration. How long can a structure remain functional when its participants are no longer aligned in intent? Some seek exposure. Others seek protection. Others seek exit. As these motives diverge, coordination becomes more fragile, even if the surface remains calm. One of the clearest signs of this fragility is the rise of conditional participation. Engagement now depends on terms, timing, and optional outcomes. What was once automatic is now negotiable. That shift alone changes the character of the market because it introduces hesitation where certainty once existed. The danger here is not that someone will panic. It is that someone will decide they no longer need to cooperate. When participation becomes discretionary rather than assumed, the system must work harder to hold itself together. And systems that work harder to maintain balance often do so by narrowing choice. This is how repricing begins without price